regulation and capital types. As a direct consequence of the crisis and uncertainty over which banks did or did not have adequate capital levels, over the past decade, governments, regulators, not to mention own in-house initiatives by financial institutions, have made a number of game-changing strides to improve transparency and ensure bank solvency levels will be robust enough to withstand another financial crisis. With the introduction of Basel III, which followed on the heels of its predecessors, Basel I and Basel II, that outlined stricter regulations on capital as well as risk-weighted assets calculation, hand in hand with the alphabet soup of banking regulations, including, among others, MREL and TLAC, and not least the myriad of government-led stress tests, not only increased minimum capital requirements, but also introduced stricter rules on what may constitute bank capital. The result of these measures has been to significantly increase the quantity and quality of bank capital, and as I will explain, replace and simplify the plethora of complicated hybrid capital instruments cannily employed in years past to leverage bank capital ratios. Today, bank capital structures are much simpler with well-defined own funds, including common equity Tier 1, additional Tier 1, and other supplementary capital known as lower Tier 2 capital, thereby shifting onus in any potential resolution strategy of a given troubled institution on the aforementioned note holders, and setting in place a clear hierarchy of loss absorption and capital subordination levels. These measures not only dispel the myth of too big to fail, but importantly, transfer the burden of losses in any financial crisis situation from the taxpayer to the stakeholder, while simultaneously ensuring institutions remain adequately equipped to continue critical functions without threatening financial market stability, as occurred in 2008. We sometimes refer to this new regime as a bail-in regime, and this is the alternative path to the many bailouts we saw during the financial crisis. So what constitutes capital, or loss-absorbing capacity for a bank, i.e. what makes the numerator when calculating capital ratios to risk-weighted assets? We start with common equity Tier 1, which forms the bedrock layer of loss-absorbing capacity, the components of which are unchanged and consistently remain shareholders' equity plus retained earnings, less goodwill and other intangibles, and dividend distributions. Next, we have additional Tier 1 capital, and this is made up of securities that absorb losses when a predetermined regulatory capital level is breached. And it is here, the former Tier 1 market, that has experienced the biggest upheaval and regulatory overhaul since 2008. Today, additional Tier 1 capital notes possess embedded contractual provisions to impose either principal write-downs or conversion into equity if or when respective minimum capital ratios have been breached, known as contingent convertible bonds, or dubbed COCOs. Today, several criteria must be met in order to comply with BIS standards of additional Tier 1 capital. A full list of criteria for inclusion in additional Tier 1 capital may be found here. As understanding and confidence in these structures develops further, we expect the market for additional Tier 1 securities should continue to grow. From 2013 to 2016, over €90 billion of additional Tier 1 securities had been issued by banks including SocGen, Deutsche Bank, UBS, RBS, Credit Suisse, and others. Both common equity Tier 1 and additional Tier 1 represent going concern capital, capital readily available when a bank hits trouble, but before the bankruptcy resolution phase. Lastly, we have lower Tier 2 capital, or supplementary gone concern capital. This is capital senior to common equity Tier 1 and additional Tier 1, but subordinate to other senior unsecured bondholders, senior preferred bondholders, covered bonds, and depositors. Lower Tier 2 capital consists of revaluation reserves, i.e. surplus created by the upward revaluation of an asset, for example, real estate owned, general loan loss provisions, and subordinated lower Tier 2 bonds. Lower Tier 2 debt is term debt issued with a maturity of no less than 5 years. Indeed, the capital component of lower Tier 2 bonds with less than 5 years to maturity will amortize on a straight-line basis annually. As an example, of a 500 million euro lower Tier 2 bond issued and maturing in 2023, only 400 million euro shall constitute lower Tier 2 capital for accounting and regulatory purposes, again emphasizing the importance that going and/or gone concern capital is to remain permanent and/or long-term in nature. So how have banks evolved to satisfy this new world of regulatory and investor scrutiny? As the graphs indicate, taking the sample of Group 1 banks, i.e. banks reporting more than 3 billion euro of Tier 1 capital, this is Common Equity Tier 1 and Additional Tier 1, from 2011 to 2016, it's clear banks made progress towards meeting the fully phased-in minimum Basel III Common Equity Tier 1 requirements ahead of the 2019 deadline. This requirement is reaching a minimum Common Equity Tier 1 ratio of 7%, comprising 4.5% minimum Common Equity Tier 1 ratio, plus 2.5% Common Equity Tier 1 ratio buffer. Further, GSIBs, also known as Global Systemically Important Banks, are also required to maintain an additional loss absorbency requirement of 1 to 2.5% of Common Equity Tier 1, which is to be phased in by 2019. Banks have adapted to this new market environment with gusto, making significant strides to improve both quantity and quality of capital levels over the past decade. Taking a look at the BIS sample of 89 Group 1 banks, the average Common Equity Tier 1 ratios have increased from 7% to above 12%. Back in December 2013 alone, the Common Equity Tier 1 shortfall of sample banks was 15 billion euro, down from 400 billion euro in 2011. Taking a small sample of UK banks, most have more than doubled Common Equity Tier 1 ratios. The empiric evidence is clear. Banks, regulators, and governments have taken many necessary measures to build a stronger, more robust, and economically resilient financial system in far better shape to withstand future economic headwinds. Further, stronger, more transparent capital structures not only place individual institutions on better financial footing, but critically mitigate the contagion effect the entire financial system suffers during times of economic stress. This is good news for all market participants, including investors, depositors, governments, and critically, the taxpayer, who it is intended, with clear loss absorbency structures in place, will no longer bear the burden of bailing out future collapsed institutions.